All right. Hello, everyone, and welcome. Thank you for joining today's webinar, Understanding the New Federal CRA Rules, Key Updates and Implications for Your Community. My name is Jane Doyle. I am the Senior Regulatory Policy Associate at Woodstock Institute, and today's webinar is hosted by the Illinois CRA Coalition, which is co-led by Woodstock and Housing Action Illinois. The Illinois CRA Coalition is a group of organizations dedicated to protecting and strengthening the federal and the Illinois Community Reinvestment Acts as tools for building more equitable communities and addressing the racial wealth gap. We conduct educational webinars like this one, coordinate comment letters when there's opportunity to comment on regulations or proposals, and we advocate on behalf of Illinois communities to ensure our CRA laws serve them well. I think many of you on today are probably already familiar with the CRA, but as a quick summary, the Federal Community Reinvestment Act was enacted in 1977 as an effort to combat redlining. It requires that banks reinvest in the communities where they do business, with a particular focus on serving low and moderate income communities. The federal regulators regularly examine banks under the CRA, and our presentation today will dive into more details about what the new rules say about the exam process. A little bit of housekeeping. After our presentation, we'll have time for Q&A, so feel free to submit your questions as they come up throughout the presentation, and we will get to them during the Q&A portion. After the Q&A, my colleague James from Housing Action will close us out and discuss what comes next. With that, I'd like to introduce our presenter. Kevin Hill serves as Senior Policy Advisor at the National Community Reinvestment Coalition, which is a national nonprofit dedicated to creating a just economy, and the organization has been a leader in CRA advocacy since its founding in 1990. Our coalition has been very lucky to be able to draw on Kevin's wealth of CRA expertise, and we're very glad to have him here today. Kevin, you have the floor.
Thanks, Jane, and thank you all for joining today. If I haven't had the opportunity to meet you yet, yes, I am Kevin Hill, Senior Policy Advisor with NCRC. The National Community Investment Coalition, as our name implies, is a nationwide coalition of groups that work to ensure that everyone in our country has chances to build wealth and live well. We know that has not always been the case due to historic redlining and ongoing discrimination that keeps many people of color out of accessing home ownership or small business capital, and also results in less community development in their communities. And the Community Reinvestment Act is a powerful tool for ensuring that the credit needs of everyone are being met. So I'm going to dive in, but again, very glad to be here, and I want to thank the Illinois CRA Coalition for offering me this invitation, and also very much have enjoyed working with this coalition on the Illinois CRA law, which I will talk about a bit. So let's get into it. So I'm going to share my screen here. Okay. All right. So here's an outline of my conversation today. So I'm going to start with going over some positive changes, some good things that we've seen, updates to the previous Community Reinvestment Act regulations that are now in the new rules. Then I'm going to spend a little bit of time on some tweaks that happened from the proposed rule, which was issued in the notice of proposed rulemaking, and that NCRC commented on, and many of you commented on. Some of the changes from the proposed rule stage to the final rule stage, we're not a fan of here at NCRC, and I'll get into why. One thing that I'm going to spend a little more time on is the changes in defining bank size, and how that can result in less CRA responsibilities for different banks at the different asset thresholds, and I'll really tie that into some of the Illinois impacts of that. Then I'm going to go over some missed opportunities, some things that were neither in the proposed rule or in the final that we'd like to see the CRA incorporate. Then finally going through some impacts on NCRC will be tracking, discussion of the CRA lawsuit. Some of you may have heard that several banking trades, including the American Bankers Association, have filed a lawsuit, which has resulted in an injunction. So these rules are on hold right now. But I'll get into why we think the regulators are on firm ground, and we're hopeful that the lawsuit will resolve favorably. And then I'll close with some things to consider during transition, both for nonprofits and for banks. So let's get into it. So starting with these positive changes from the previous Community Investment Act, which I think I'll refer to as Legacy CRA or CRA Classic. So I've written a lot of comment letters on CRA exams over the years, both for NCRC, and I've also assisted many of our members with writing their own comment letters. And frequently, CRA exam comment letters would usually focus on making an argument that a bank was not doing enough lending to low-income borrowers or small businesses. And it was really it was not very objective or transparent previously how the regulators were determining this crucial aspect of CRA is, is a bank doing a satisfactory level of lending to underserved borrowers or businesses. The new CRA rules will dramatically improve that process. We have a much more objective and transparent retail lending test now that establishes that a bank's lending will be compared to both what does the total lending look like from all lenders in that area, as well as what does the demographics of that area look like, and how does that compare to the lending patterns. And there's established thresholds of performance depending on where a bank lands based on those two factors, the aggregate lending of all banks and then the demographics of the community. And you can see the full thresholds on a guide we've put up on our website. But in order to just kind of put it plainly and summarize, in order to pass the retail lending tests, large banks must lend at levels that match either 80% of the total lending by all lenders to borrowers with lower moderate incomes or small businesses and farms, or at 60% of the demographics. So just to kind of break that down a little bit, and for the sake of simplicity, let's say in an assessment area, 10% of all loans were going to low-income borrowers. And for sake of simplicity, let's say 10% of all people in that assessment area were also low-income borrowers. So in order for the bank to pass in that assessment area, they would either need to be at 8% of their loans going to low-income borrowers, because 8 is 80% of the 10%, or they would need to hit 6% of their loans going to low-income borrowers if low-income borrowers accounted for 10% of the assessment area. I just use that because it's a simple way to show that. And they have to hit those levels in 60% of their assessment areas in order to pass for large banks. This will change the lending test pretty significantly. The regulators have looked at data from 2018 to 2020 and to determine, how would this break down if this was already at play. And they found that a little more than 9% of banks would fail their lending test if this were already in place. And so this is very important. As you know, 98% of banks currently pass their CRA exams. It is very rare to find a bank that doesn't pass their CRA exam. And the lending test is a very critical component. So if we're having a dramatic increase in number of banks that potentially could be failing their lending test, it will encourage banks to really look at their lending patterns and to make sure that they're able to hit these benchmarks. So we think that this could have and again, these are things the banks can do. It may just require the banks to kind of reassess maybe some of their product offerings, maybe looking at more down payment assistance. But we do think that this is something the banks can achieve, and it will result in changes. We don't expect necessarily 9% of their banks to be failing going forward, because we suspect that banks will make changes to respond to this more fleshed out retail lending test. And that's exactly what we wanted to see with the CRA reform process. We wanted to see more objectivity and a higher raising the bar on what it means to be a passing CRA bank. In addition, this analysis has gotten much more granular. Previously, small business lending was looked at only for small businesses under $1 million in revenue. That has been updated to also look at businesses under $250,000 in revenue. So we want to see that breakdown even further of how, what does the small business lending look like, not just to businesses that are at that million threshold, but as well down to 250,000. Also, much more of a bank's total mortgage and small business and farm lending will be included in CRA exams now due to the new assessment areas. So let's move into the new assessment areas. You can see on this slide that we still have kind of the legacy assessment areas or the classic assessment areas, which have now been rebranded as facility-based assessment areas. So this is what CRA as we have it now, where a bank has branches or as well as deposit-taking ATMs. That's where then they'll, be evaluated on the retail lending test and all the other tests. So that's still there. But there's now 2 new assessment areas on top of that for certain banks. And these are the retail lending assessment areas and the outside retail lending area. So retail lending assessment areas apply to large banks that do less than 80% of their lending outside their branch, do less than 80% of their lending inside their branch network. So they're doing more than 20% of their lending outside their branch network. And they'll kick in markets where they hit these thresholds of either 150 closed-in mortgages or 400 small business loans in each of the last 2 years. And if you're curious what a closed-in mortgage is, it's most traditional mortgages are considered closed-in mortgages. Things that are considered open-ended mortgages are like lines of credit, like a home equity line of credit. That's not going to show up here, but regular closed-in home purchase loans where there's a set loan amount and you pay it back over time with interest. That's what's a closed-in mortgage. And the idea here is that, there are banks that are lending in markets, even though they don't maintain branches there, but they're doing a considerable amount of lending. And the purpose of the Community Reinvestment Act is to evaluate banks on how well they're meeting credit needs in their entire community. And in the online world we're in now, branch networks are not the best predictor of where banks lend. Many banks, many large banks around the country are lending all over the place, regardless of whether they have branch networks. But under the previous CRA rules, that was not being captured at all. So the retail lending assessment areas will kick in markets where the bank's already doing an established amount of lending. And the retail lending assessment areas only apply to whichever type of lending triggers that threshold. So if they're doing a more than 150 closed-in mortgages over the last 2 years, they're going to be analyzed on mortgage lending. But if they didn't do 400 small business loans, then there wouldn't be a small business analysis. It would just be the mortgage analysis. Same thing for small business. If you trip the small business threshold but not the mortgage threshold, you'll only be analyzed on small business. And so then the outside retail lending areas, this is a nationwide assessment area that'll apply to all large banks, as well as intermediate banks that do more than 50% of their loans outside of their branch networks. And the outside retail lending area it's basically the catch-all. So it's all the lending that wasn't in the other assessment areas, the traditional branch ones, and then the new expanded retail lending areas. And so they wanted to be able to capture loans that were kind of distributed throughout, but weren't concentrated in specific markets. And other than the issue of just making CRA relevant today, and making sure that, we're really analyzing the bank's total lending on how well it meets credit needs, it's also really critical to have a CRA review of more loans, because a part of a CRA review is also the safety and soundness of the loans offered. And there has been studies after the 2008 housing crisis that even identified that banks' loans made in their traditional CRA assessment areas were safer and sounder, meaning less likely to result in foreclosure than than loans the same bank was making in areas outside of its assessment areas that were not subject to a CRA review. And this modernizes CRA, and it also ensures that there's much more of a safety and soundness review going forward, and that it helps to eliminate a very critical blind spot where banks lending outside of branch networks was not really captured currently. I will discuss this a little bit more in the CRA lawsuit discussion because this is one of the things the banking trades particularly did not like about the new CRA rules. Moving into community development, there are some new categories of CRA eligible community development that encourage banks to pursue loans and community development loans, investments, and grants on native lands, which was a very critical issue. It was kind of almost an unintended consequence of CRA previously that since there's a few bank branches on native lands, there was not a lot of CRA activity on native lands for that reason, since banks were worried they wouldn't get credit for it. That's been cleaned up in the new CRA rules. And there's also as well this new category now of weather resiliency, which is things designed to reduce the harm of significant weather events and things like that. One of the things that's particularly noteworthy for both nonprofits and CRA officers out there is that once these new CRA exams start to get rolled out, they will now include how much of a bank's community development activity fits into 12 different categories of impact and responsiveness. And there's going to be a reporting of each category, how much of the activity fits into each of these 12. And I'm not going to go through all 12 categories. I've pulled out 2 on this slide, but the 2 are available on the guide I mentioned in our website, which is linked later on. And the idea here behind these different categories of impact and responsiveness is that the regulators will give sort of positive consideration for these things that are seen as having this high impact. And they're really trying to encourage more CRA activity in areas where there's really high need. And so therefore the activity could do more because it's being done in an area of significantly high need. And 2 of the categories that I'm pulling out here are activities that serve persistent poverty counties. And persistent poverty counties it's defined by HUD. These are counties that have had over 20% poverty rates for the last 30 years. These tend to be rural counties. And then another category is census tracts with poverty rates 40% or higher. Census tracts, it's not counties, but census tracts with poverty rates 40% or higher. Those tend to be urban census tracts in cities where there's very high poverty rates. So the idea here is that they're trying to really encourage the more CRA activity in those areas of very high need. And the note here for the CRA officers out there is I've gotten to know many CRA officers in my time here at NCRC, and I know CRA officers you're very diligent. And I know you're going to want to make sure you can avoid as much as possible having nothing to report in these various categories. So the call here to the CRA officers and to the nonprofits is that really be mindful of, is there things in your community development portfolio in these persistent poverty counties or in these census tracts of poverty rates of 40% or higher? And if you're a nonprofit and you're doing work in those areas, absolutely start mentioning and talking to banks about the work you're doing in these high need areas and how it would provide the banks an opportunity to have things to report for this category. If you're curious on how this kind of looks in Illinois, the Illinois cities with census tracts 40% of poverty rate there, excuse me. Unfortunately, there are census tracts in Chicago that have these census tracts with 40% or higher poverty rates. There may be other cities in Illinois that have these as well, but I can say for certain that Chicago has census tracts with these 40% or higher poverty rates. Persistent poverty counties in Illinois include Alexander County, Gallatin County, Jackson County, and Pulaski County. So if you are doing, if you're doing like any services for people living in those census tracts in Chicago, if you're doing home buyer workshops or helping small businesses there, you absolutely should be talking about it with your banking partners and with banks you may not have relationships with. And banks that have Chicago as an assessment area or are in these persistent poverty counties, you should definitely be looking for community development projects in these areas. The last kind of positive change I want to talk about today is the special purpose credit programs. Special purpose credit programs are basically programs that lenders can set up that allow them to open up their underwriting a bit and to factor in race. The Equal Credit Opportunity Act forbids the use of race in underwriting in most instances, but a special purpose credit program is sort of an exception. And in order to set one up, a lender needs to put together a plan that'll detail, why they're setting up the program in order to lend to members of protected classes that their ordinary underwriting procedures would not have lent to or would have lent to with higher terms. So for instance, it's well documented that credit histories are not accurate predictors of many people of color's ability to make mortgage payments. And we've seen, Fannie Mae and Freddie Mac start incorporating rental history into some of their underwriting guidelines. So a special purpose credit program, for example, for African American borrowers that maybe would factor in rental history as evidence of ability to make mortgage payments, that could be an example of a potential special purpose credit program. And the good thing, why am I talking about this? Because large banks will receive positive consideration on the development of special purpose credit programs on the retail services and products test. And the intermediate and small banks out there, they do not have the retail services and products test, but they could still receive positive consideration. So if you're a bank in the audience today, there's one thing you take away from this. Special purpose credit programs will help you pass your CRA exams. So please do strongly consider developing these or working with nonprofits to develop these if you're not doing so already. Now let's get into some of the unhelpful tweaks. So these are the things I'm talking about in this section. There are things from the proposed rule, because remember, there was an NPR stage where the FDIC, the OCC, and the Federal Reserve were basically made a suggestion of this is how we're going to tweak the CRA rules. Then many of us commented, and then they've made some changes. And a positive change was the addition of special purpose credit programs. That was not originally in the proposed rule, but NCRC and many others, including many members of the Illinois CRA Coalition, mentioned it in comments, and we were able to get that in. But unfortunately, not all of the changes from the proposed rule to the final rule were positive in NCRC's opinion. So the thresholds for the retail lending assessment areas, these were increased, meaning that 150 and 400, those are increased. I believe it was previously 100 and 250, or maybe it was 100 and 200, but basically they increased the thresholds for when the retail lending assessment areas kicked in, and they also added that 20%. That was not previously in there. It was previously just going to apply to all large banks if they hit the thresholds. The effect of that is that they've basically cut in half how many banks will have retail lending assessment areas and the number of retail lending assessment areas that will be created, which inherently means less lending will be captured now on the test. One thing I want to point out about retail lending assessment areas, based on these new thresholds, the regulators estimate that 80% of banks won't have to, 80% of large banks won't have to create any additional retail lending assessment area. And about 13% will have to create between 2 and 10. And there's about 5 banks in there that will have to create a pretty significant 50 or more. So the retail lending assessment areas, it largely affects, the largest lenders out there. And those are lenders with, very significant asset sizes that will be able to find ways to effectively serve these areas. They just may have to, pay a little more attention to their lending distribution in these communities than they had to before, but that's exactly the point of the Community Reinvestment Act. Also, auto lending. Auto lending was initially a part of the proposed rule, and it was, but it was going to be a part of the retail lending test. Banks are going to evaluate on their auto lending to low to moderate income borrowers and how safe and sound it was. That has been tweaked. Auto lending will now only be evaluated if it accounts for 50% or more of a bank's total retail lending. We don't agree with this change because we know auto lending is a very important part of how many people get to work. Many cities don't have very effective public transportation systems, and a car is, a very needed asset. And we want to make sure that those loans are also being safe and sound. There's a lot of information out there on predatory auto lending, and so we were very happy to see this in the proposed rule, but we're displeased when we saw in the final rule it's been changed to only factor in banks that do that basically half or more of their total loans is auto loans. We think that'll apply to few banks, or we know that'll apply to few banks. There is also this bank's option to include. So like if a bank is making a lot of auto loans to all my borrowers, they may choose to include it because they may think it'll help them pass, but it won't be automatically included unless it's half or more of their lending. Um, the other unhelpful changes, there is an evaluation of credit and deposit products. Bit more to come on that when I get to the CRA lawsuit. And this can only contribute positively to a bank's CRA performance, which is a change from the proposed rule. The regulators first proposed that the evaluation of credit deposit or credit and deposit products could contribute positively or negatively. So if a bank was out there that only had really expensive checking accounts or loans that with very high interest rates, there could be some downgrade there, and there should be some downgrade there, because how is a bank meeting the credit needs of the entire community if a good portion of the community would not have access to those products, or would hurt those products because they would take more of their income in fees. This has been changed to again only factor positively. So there's no banks cannot be downgraded for only offering expensive deposit products with high fees or unaffordable loans. Also, one of the tweaks there, the community development test for large banks has been changed. Previously, large banks had a lending test that looked at community development loans in addition to retail loans, and an investment test that looked at their investments as well as grants. There's now a new community development financing test that combines loans and investments. There is a concern among NCRC and many of our members that combining loans and investments could result in less investments. And that's because investments are more complicated. It's a little harder for a bank to set up a community development investment, like a low-income housing tax credit or a new market tax credit, than it is for them to set up a community development loan. So there is a concern that we could see a decline in investments, and these investments are absolutely needed for preserving affordable housing in high-cost areas. So we're going to be looking, and so in response to this, the regulators added a new investment metric for banks above 10 billion, but they tweaked that investment metric can only contribute positively. And that is a change because all banks above 10 billion previously had an investment test, and their performance could go up or down depending on how well they did on that. In general, we're not a fan of this anything that's only contribute positively. We think if something is important enough to be in a CRA exam, and then the lack of it should also, trigger negative consideration. We really don't agree with things that are only factored in positively. If it's important enough to be in an exam, it should count negatively or positively, depending on how the bank performs on that aspect. Now getting into another pretty significant change that could have some negative ramifications is the changes in defining bank size. The Community Reinvestment Act operates under a very common sense principle that the larger the organization is, the more that can be expected of it. And so there's 3 tiers of banks. There's small banks, intermediate banks, and large banks. There's also rare banks that operate under strategic plans or are limited purpose. But in the interest of getting this presentation done in an hour, I'm going to focus on the more common banks, which are the small banks, the intermediate banks, and the large banks. And so as you go up this scale, your CRA responsibilities get increased. Large banks have a lending test a community development financing test, a retail services and products test, and a community development services test. So they have 4 tests that looks at things like lending, community development, and their branch networks. When you drop below the large banks, you have intermediate banks that just have a lending test and a community development test. They don't have tests on their products or their branch networks and things like that. When you drop below intermediate banks to small banks, you just have a lending test. And the lending test for small banks is also much more straightforward, or it's simpler. It's basically just looking at, are you making loans in areas where you have branches? That's really the thrust of it. And there's also some safety and soundness review too. Um, so, so when we change these asset definitions and we raise them as the regulators have, you're gonna shift which banks have which tests. And so they've done that, as you can see in the slide. Large banks are now 2 billion in assets above. They were previously 1.56 billion. And that would change previously based on inflation. So it wasn't a static. They already had a method of updating based on inflation, but these new changes go well past inflation. So 1.56 got raised to 2 billion. Intermediate banks are now between 600 million and 2 billion in assets. They were previously 391 to 1.56. Small banks are now 600 million in assets and below, whereas previously they were 391 million and below. So what is the impact of this? Nationally, 407 fewer banks will have a community development test as a result of the increase in raising the small bank threshold, because small banks do not have a community development test. They just have a lending test. So a little more than 400 banks no longer have this test, 30% decrease. Similarly, because of the raising of the intermediate threshold, 135 banks throughout the country will now no longer have a service test, resulting in about a 19% decrease across the country. In Illinois, 32 less banks will have a community development test, a 40% decrease, and 9 less banks will have a service test. If you're wondering who are some of these banks in Illinois that are going to have less CRA responsibilities, I kind of gave it away a second ago, but here they are. So this isn't the complete list, but these are examples of Illinois banks that will lose their community development test as a result of the increased thresholds, as well as Illinois banks that'll lose a service test. So there is a concern that these banks will have much less interest in supporting community development projects in the case of Longview, Bank of Hillsborough, and Stillman. And then those other banks below that are losing a service test, they may start closing branches because they'll have less of a CRA reason to keep branches in low to moderate income census tracts now. So missed opportunities. These are things that were not reflected in the proposed rule, but that many people wanted to see. And we know that because many people's comments to the regulators on these included things along these lines. First and foremost, there's been very little progress on the federal CRA and incorporating race into the CRA process. The regulators will start posting Home Mortgage Disclosure Act information on agency websites, but that information, which was already available to the public, will not have any bearing on CRA exams currently, on federal CRA exams. And this is really, this is a major hindrance to the Community Reinvestment Act's ability to achieve its statutory purpose of evaluating banks on how well they meet the credit needs of the entire community. And so that's the statutory purpose. And we also know that the reason community members wanted the Community Reinvestment Act is because they wanted a way to address redlining. Redlining was largely discrimination based on race. And so it's been an unfortunate part of the federal CRA since 1977 that it is largely colorblind. And this has very real world ramifications. We've done analysis that since 2016 that has found more than 10 banks since 2016 where the OCC, the FDIC, or Federal Reserve was passing those banks, giving them satisfactory or outstanding CRA scores, while another regulator, the Department of Justice, that's not limited to being colorblind, was finding evidence of redlining and discrimination. So we continue to advance recommendations for how race should be incorporated into CRA, and we'll continue to do so. And I'm very glad to say that the Illinois State CRA law, with the addition of the recently passed Illinois SB 3235, will implement will create a disparity study that'll identify communities that exhibit signs of discrimination, and gives the Illinois financial regulator, the Illinois Department of Financial and Professional Regulation, gives them the ability to incorporate that study's findings into the state CRA process in something that will take another rulemaking. But it does create an opening for race to be factored in a much better way, to really focus in on how are banks serving the credit needs of those who are currently benefiting the least from our banking system. And the Illinois CRA law also doesn't just apply to banks like the federal CRA law does. It also applies to mortgage companies that are making, I'm pretty sure it's about 50 mortgages a year, and also applies to credit unions. So one of the reasons I'm so glad to be working with the Illinois CRA Coalition is because y'all get stuff done. You all should be very proud of having one of the strongest state CRA laws in the country, that really is a model for how the federal CRA laws should be updated. So everyone who's been involved in Illinois CRA work should feel very proud of themselves. No changes to, and then moving on to some of the other missed opportunities, is no changes to how CRA performance affects merger and branch applications. Many people are commenting that we wanted to see a little more encouragement of community benefits agreements, and really kind of goal setting for mergers and new branches, so we could see like exactly how banks were going to measure, how is this merger helping them better respond to credit needs and things like that. They did not make those changes, but they did note, in a helpful note, that majority of the commenters supported the use of community benefits agreements, which is a note we're definitely going to remind the federal agencies of as we continue to have conversations about how to improve the bank merger process. There's also been not many changes on public engagement. We were hoping to see the regulators create a public registry where groups could sign up to be contacted by regulators to share information about what they see as some of the kind of most pressing community development needs in their communities. The regulators have chosen not to adopt that, and there really hasn't been much improvement on public engagement, which is why it's very important that all of you be as proactive as you can be in commenting on CRA exams, because unfortunately the regulators have not adopted recommendations for them to be more proactive. So community groups need to kind of fill in the gap here and be really active in voicing, you're really active in voicing how banks should best serve your communities, and things that aren't going well in your community, and things that are going well in the CRA exam process. So some of the impacts that we'll be tracking here at NCRC of these new CRA rules, once they go into effect, is the mortgage lending for borrowers low to moderate income, as well as people of color. We're very interested in seeing how will that stronger and more objective retail lending test translate. We think it should translate into more loans being made to low-income borrowers, which was exactly the point of CRA reform. We'll also be seeing if there's any unintended consequences of the effect of new assessment areas, such as a curtail on lending, which is something the banking trades has said could happen. I am personally very skeptical of that happening, and I can provide more detail on that if anyone likes in the questions. We'll also be looking at new development of new special purpose credit programs. Banks out there, remember, special purpose credit programs will help you pass. We'll also be looking if there's any loss of branches or community development caused by the new asset thresholds, and as well as potential declines in investments caused by combining them. Now let's get to the CRA lawsuit. So these new rules came out October 2023. A month or two later, American Bankers Association, Independent Community Bankers Association Chamber of Commerce and a few state bank associations, like one in Texas. They filed a lawsuit to repeal this new CRA rule, which now places the new rules on hold. The two things that their complaint really focuses on is the new assessment areas. They don't want lending outside of branch networks to be factored in. And they also don't want Community Reinvestment Act to evaluate deposits. And in fact, the lawsuit doesn't just, they're not just trying to take back the 2023 CRA rule. They're also trying to go all the way back to 2016 and repeal guidance in 2016 that said that regulators could look at deposit products as a part of evaluating how banks were serving low to moderate income borrowers. So let's get into the assessment area issue. The point of the Community Investment Act, again, you can look up the law. So basically, let me backtrack a little. Basically, what they're arguing is that the regulators exceeded their statutory authority, meaning they exceeded what the Community Investment Act gives them the ability to do by creating these new assessment areas and by looking at deposit products. And they're taking their argument is basically that, since there's nothing in the statute about beyond branch networks, you have to be limited to branch networks. But that is a very rewrite of CRA and doesn't really respond to the legislative history. It's clear in the Community Investment Act that they're evaluating banks on how well they serve credit needs of the entire community. And in fact, there was initially language in the Community Investment Act that would have been much more narrow. And instead it got entire community. And the reason why in other portions of the act, you see a focus on the branch networks is because the Community Investment Act was written in 1977. In 1977, there wasn't the internet, there wasn't smartphones, and then lending really was tied to branch networks. The people writing this law in 1977 could not have envisioned, what we have today and the ability to, get a mortgage from a bank that has no branch anywhere near you. So really what the agencies have done here is just update the Community Investment Act as federal agencies are expected to do. And we believe that the language in the law about serving entire community and the history there of how they rejected more narrow language will do them well. And it's also important to remember the banking trades contradict themselves massively on this point. They say, it has to be restricted to just branch networks. But when they talk about community development, the banking trades absolutely want to be able to get community development anywhere in the country. You can pull up ABA's NPR comments, ICBA's NPR comments, and you will see early on in those comments, we absolutely support being able to get community development anywhere in the country. So really what the banking trades play here is they want to minimize areas where they could have negative CRA performance. They don't want to have to consider what does lending look like in communities where I'm lending, but I don't have branch networks. Because if they don't address that and there's an issue, they could have a reduction. But they will absolutely want to be able to get credit for community development anywhere else. So they're really just trying to minimize areas where they might have to make changes and maximize areas where they can just continue to get positive credit. On the deposit issue, they're basically saying, since the statute doesn't, there actually is language in the statute about deposit needs being a part of credit needs, but there's not there is not the explicit list in the Community Investment Act of all the different factors of what should be considered on how you evaluate whether a bank's meeting credit needs, which actually benefits this because the Community Investment Act leaves it open to the regulatory agencies to basically figure out what are the factors that need to be considered when evaluating how a bank is meeting credit needs. Those things can change over time. They wanted to give agencies, some leeway here and discretion to be able to determine what are the things you need to factor in evaluating these needs. So the regulators have then taken that and determined that yes, the ability to have a checking account, is a very crucial part of being able to have credit. I don't think many people would argue with that. So we think this is a pretty straightforward thing. that the Community Investment Act to include. And also remember as well that this can only contribute positively in a CRA exam. So the banking trades are literally filing a lawsuit to pull down something that can only contribute positively as currently constructed. I'm gonna move through. I got like a little more slides, and I'm gonna realizing the time, so I'm gonna move a little quickly. But yeah, so if this were approved, this lawsuit, it would take CRA back to its last significant update in 1995, which would be really damaging for communities. Communities do need a stronger lending test. We can't continue to have 98% of banks failing their CRA exams, and it being a very subjective and non-transparent way of identifying banks that are satisfactorily lending. Like we need the stronger benchmarks, we need the stronger thresholds that the new retail lending test establishes, and we absolutely also need affordable deposit products. And then also the banking trades are claiming that this really burdens the entire banking industry. Most of these changes really predominantly affect the largest banks, 2 billion or 10 billion above in assets. And the new serial even furthermore reduces CRA responsibilities for over 500 banks. So we're feeling cautiously optimistic about the lawsuit. The briefs are due from the agency briefs in defense of it are due October 9th. The case will probably start hearing arguments in late October. And we're expecting to know around December to February of kind of where the court will land on this. And then at that point, there may need to be some changes, or hopefully the new CRA rules will just keep going and there may be a change in timeline. Most of these changes were not anticipated to go into effect till 2026 anyways. That calendar may get pushed back a little depending on the length of the lawsuit, but we should be hearing soon. And again, we're feeling confident that the courts will decide that the regulators did not exceed their statutory authority. So as we kind of prepare for these new CRA rules to take effect, for nonprofits, really familiarize yourself with local lending data. Look for banks that are lending in your communities that don't have branches and may have those new retail lending assessment areas. Because if you're doing like home buyer workshops or small business assistance, the things you're doing can help banks kind of improve their lending. So get very familiar with who those banks are, and if there's new banks now that will have CRA responsibilities for your community. And also, figure out how your work fits into the different categories of impact and responsiveness. There's not just those two I shared. There are 12 of them, but I just didn't feel like going through all 12. But yeah, familiarize yourself with those different categories and start positioning yourself for conversations with banks about them. And also create a plan for which bank exams you want to talk about. And start talking to banks about special purpose credit programs. For the banks, very similarly, start looking at your lending outside of branch networks. How does it break down? How much to businesses under 250,000? And really evaluate, you're going to want to avoid zeros as much as possible when you have to show that breakdown of your community development in the different categories. So take a look at that. And then again, special purpose credit programs will help you pass. So please strongly consider developing that. And then I've got some resources for when we send out the slides. I think it's pretty straightforward what those resources are. So I'm going to stop here and happy to take some questions.
Thanks, Kevin. Sorry, I'm going to pop back on the video here, and I'll run us through kind of some of what came through in the Q&A and the chat. So the first one related to the retail lending test and whether the metrics there related to the amount of the loan or the number of loans that banks are giving out, the 60 and 80%.
So the retail lending test will look at its number of loan distributions. It'll look at the number of loans. But the way it'll be weighted, so so that's how it's going to look in each assessment area. It's going to look at number of loans. And so your number of loans need to be at either the 80% of the total lending or the 60% of demographics. And then that gets factored in, like when they have to put all the assessment areas together to arrive at a final test, then they'll factor in number of loans and loan dollars in order to do the weighting. But on the part about the 80, 60, and 60%, that's all based on number of loans.
Perfect, thank you. Next one related to special purpose credit programs. A question about, are the race considerations under those at risk in any court cases or court interventions at the moment?
Good question. It's been coming up a lot. In particular, I think those questions were increased after the affirmative action decision. So NCRC is actually working right now on a paper with the Relman Kolpak Civil Rights Law Firm that will provide a very detailed kind of legal defense of special purpose credit programs in light of that. But we also have already done a blog on this, but we're working on a more detailed paper. But the kind of highlight here though is, there's a very different issue at play in the affirmative action decision. The affirmative action decision was pushing back on the idea that diversity in and of itself is a benefit. And while I personally agree with that, the special purpose credit programs purpose of that is much different. Special purpose credit programs are not designed to increase the diversity of homeownership. They're designed to address the inequities of our legal system, of our lending system, and to really address that and to ensure that groups that are either protected classes that either for various reasons were not getting lending previously could have underwriting change to give them more access. So it's much different. It's not about diversity for diversity's sake. It's about it's the justice thing. It's about making sure that groups that faced discrimination in the past and would not get loans previously could now have access to it. So it's different things, and there's also a whole slew of previous legal research and reasons of discrimination in the lending market. So we do think that special purpose credit programs are still on firm ground, and more to come from us on that issue.
Great, thanks. And there was a quick follow-up to that of amid the trend to move away from DEI products and related engagements, do you think institutions will hesitate to use special purpose credit programs as a result?
Well, again, special purpose credit programs will help you pass your CRA exam. So I hope they won't. And I mean, these are also, I think, let's not forget why banks make mortgage loans and small business loans. They will profit off these loans. So this is really about expanding the customer pool. If you think about it, expanding the customer pool for banks, and doing so in a safe and sound way. So I'm hopeful to see that the thumb on the scale for special purpose credit programs will hopefully result in more of these programs.
Thank you. Then our next question is there any movement on creating community development standards on environmental justice for community development activities?
There's definitely a movement for it. It's not currently reflected as much in the current CRA regulations. The weather resiliency it's important, but it definitely stops short of activities designed to just decarbonize in general. It's very tied to, if there's a storm, will an affordable housing project lose power? And if we put a community solar project in here, that way it won't lose power. So that's the kind of stuff that's currently reflected. But whoever asked that question, you're spot on in that the Community Reinvestment Act could go further in environmental justice, because this is an issue I'm personally very interested in, and NCRC is getting more interested in, because as climate change increases, loan opportunities in many low income areas are going to become harder to do in many parts of the country as insurance seeks to pull back. And there are some of our largest banks are some of the largest financiers of things like increased pipelines and things like that further lock us into climate change. So we at NCRC are very much looking at how the CRA can be a more effective response to climate change. because it doesn't do as much as it should now. That's something that's an area that we're very interested in right now at NCRC.
Perfect. And our last question for today is going to be, what are you hearing about Section 1071?
Section 1071, I believe, I'm pretty sure, has cleared its legal hurdles. And so I believe 1071 is good to go now. I mean, it's not, they're not collecting the data today, but I don't believe there's any further legal hurdles with 1071. And one of the things, the banking trades were saying all this stuff like, oh, this is so burdensome having to collect all this data and create a new form. And I did think it was, and we have blogs on our website about that issue. But I did think it was pretty comforting that one of the judges, which was even a former Republican appointed judge, even they didn't buy those arguments. They said, like, this really doesn't sound as burdensome as you're making it set out to be. Like, I think you can figure out forms. There is even examples of the form that you can use. So yes, 1071 should be moving forward, and it's absolutely needed because we need to have a much better sense of how businesses, the various businesses owned by people of color, businesses owned by women, how they're being treated when they apply for loans.
Perfect. Thank you, everybody, for your questions. And thank you, Kevin, so much again for your time today and coming on to talk about the new rules. We really appreciate it. I know we are fully out of minutes here. I'm going to just take.
My apologies. That took a little longer than I anticipated.
No, it was incredible. A lot of great information for everybody. We really appreciate your time and your expertise on this. I just want to invite everybody who participated and attended today to visit the Illinois CRA Coalition webpage. The webpage here, the address is provided here. We'll also be sending around these slides later and you can connect to us that way. On the webpage, we post the latest updates about the federal and the Illinois CRA. On that page, you can sign up to receive any future updates from us, as well as notifications about our education and advocacy activities. We also post everything from our activities in the past. We have comment letters that we provided to state and federal agencies, as well as webinars like today's. And this one, I think, as we said earlier, will be posted on that webpage in the weeks to come. Our next planned CRA activity will be an Illinois CRA session at Housing Action's annual Housing Matters Conference. It's going to be taking place on October 17th and 18th in Bloomington, Illinois. We only have about 50 slots left for the entire conference, so if you're interested in attending, I would sign up quickly. In that session, we're going to cover the opportunities created by the Illinois CRA and how it can help communities deepen and broaden their impact. Over the course of the next year, the rest of our work is going to focus in two areas. First, we're going to be developing resources, hosting meetings, and providing education to help increase the awareness about the Illinois CRA and help community-based organizations utilize and monitor the implementation of that law. Second, we're going to be monitoring the development and rulemaking around the disparity study that Kevin mentioned earlier. That study is going to help identify and define places in Illinois exhibiting significant disparities with respect to access to financial products and services. We currently have information about the study on our webpage, and we'll be posting future updates soon. Please reach out to us at the Illinois CRA Coalition or Kevin if you have any questions as a result of this. And thank you all for joining us today. Have a great weekend.
Thanks, everybody.